Welcome to Earnings Recap. Today we're covering Honda's earnings report and call.
And interestingly, kind of buried amidst all the numbers was this news about them hitting pause on a huge $15 billion Canadian EV investment.
Yeah, that definitely caught my eye. Said the North American EV market's just growing slower than they expected.
Yeah.
So today we're going to break down Honda's latest financials and what they said on their call.
All right, we'll try to put it all in plain English for you.
Yeah.
We're looking at their official results for the fiscal year ending March 2025, the press conference chat, all of it.
And our mission, as always, is to pull out the really key stuff. What the numbers mean, what might happen next.
Yep.
Basically give you the quick, thorough rundown.
Exactly. No need to wade through hundreds of pages yourself.
Okay, so let's dive in. Fiscal year ending March 2025. Sales revenue first. It actually went up, right?
It did, yeah. Up 6.2%, reaching JPY 21,688.7 billion. Pretty solid increase.
What drove that?
Two main things, really. Their motorcycle business was on fire globally, record sales. And currency exchange rates helped them out quite a bit, too. Favorable shifts there.
So motorcycles doing great. Record profits there, too, I saw.
Absolutely. Record unit sales, record operating profit, and even their profit margin was the best ever for motorcycles. Real bright spot.
Okay, but then we get to operating profit overall, and that actually went down quite a bit, too.
Yeah, that's the tricky part. Down 12.2% to JPY 1,213.4 billion. But there's a big asterisk there.
Nice asterisk. What was it?
Well, that figure includes let's call it a one-time hit of JPY 127.6 billion. It was because they changed how they account for future car warranty costs. Basically, they set aside a lot more money.
Ah, okay, so an accounting change, not necessarily core operations declining that much, if we take that out.
Right. If you look at the profit before that specific charge, it was JPY 1,341 trillion, still down compared to the year before by about JPY 40.8 billion, but not nearly as steep a drop.
Got it. So still a bit weaker year-on-year operationally, even without the accounting item, and overall net profit.
That took a bigger hit. Net profit attributable to the parent company was down 24.5%, landing at JPY 835.8 billion.
So motorcycle strong, but something else must have been dragging things down. Was it the car business?
You nailed it. The automobile side faced headwinds, unit sales fell, especially in China and the Asian region. And in North America, they had to spend more on incentives to sell their EVs. That eats into profits,
Right. The EV push costs money up front. Any good news on the car side?
Well, yes. Sales of their hybrid EVs actually expanded, so that's a positive trend they'll want to build on.
Okay, good to know. And despite the lower profit, what about cash flow? Did that hold up?
It did, actually. That's a key point. Operating cash flow, even after you adjust for R&D spending, stayed quite high at JPY 2.8 trillion.
So that means they still have firepower for investment, even with the profit dip.
Exactly. It shows the underlying business is still generating strong cash, which is crucial for funding future stuff like, EVs and R&D.
Okay, let's dig a bit deeper into why operating profit slipped, even before that accounting change. What were the main drags?
Several factors piled up. The lower sales volume itself cost them about JPY 233.6 billion in profit. Then there were JPY 85 billion in sort of miscellaneous higher expenses.
Okay.
And a big one, R&D costs went up by JPY 153.5 billion. They specifically mentioned putting more resources into EV development. That's a necessary investment, but it hits the bottom line now.
Right. Investing in the future. Anything else?
Yeah, currency swings actually turned against them a bit on the profit calculation side. A negative impact of JPY 93.6 billion there, separate from the revenue boost. So quite a few things pushing down.
That adds up. Were there any positives pushing profits up to partly offset those?
Oh, definitely. The biggest positive factor was what they call price and cost impacts. That added a huge JPY 525 billion.
Wow, how did they manage that?
It seems they were able to get better prices for their products. For motorcycles, they mentioned responding to inflation in emerging markets and improving product value. For cars, too, they talked about pricing reflecting improved product value. So better pricing power helped a lot.
So even with challenges, they could still command decent prices for their products. Interesting. Let's break it down by business segment then. Motorcycles, we know it was a record year.
Yeah. Stellar performance. Operating profit hit JPY 663.4 billion, which was up JPY 107.2 billion from the year before. Record high. Driven by selling more bikes and getting those better prices we just talked about.
Can't argue with that. Now, the auto business, we know profit was down overall. What do the numbers look like there before the accounting change.
Right. Before that warranty provision change, the auto business operating profit was JPY 243.8 billion. That's quite a drop down, JPY 189.1 billion year on year.
Ouch. And the reasons were the lower sales volume and those EV incentives mainly.
Exactly. Those were the primary drivers. And they gave some really stark numbers on the EV side specifically. They said their battery electric vehicles, BEVs, had a negative gross profit of around JPY 200 billion.
Negative profit on the cars themselves.
Yes. And on top of that, R&D spending just for BEVs was another negative JPY 400 billion. So put it together, the whole BEV effort is currently running at a significant net loss.
Wow. So where's the auto profit coming from then?
It's coming from the traditional internal combustion engine cars, and importantly, the hybrids. They estimated that segment, ICE, including hybrids, generated roughly JPY 1 trillion in profit.
That is a massive contrast.
Yeah.
It really highlights the financial challenge of this transition, doesn't it?
It absolutely does. The future might be electric, but right now it's a heavy financial lift for them, while the traditional business still pays the bills.
Okay. What about their other segments? Financial services.
Financial services did well, pretty steady. Operating profit of JPY 315.6 billion.
And power products. Lawnmowers, generators, that sort of thing.
That segment actually had a small operating loss, about JPY 9.4 billion.
Okay, got the picture for the past year. Now let's shift gears and look ahead. The outlook for the current fiscal year, ending March 2026. It looks pretty gloomy, doesn't it?
Gloomy is one word for it. Yeah, they're forecasting a drop in sales revenue, down 6.4% to JPY 20.3 trillion.
Okay, lower sales. But the profit forecast is the real shocker.
It really is. Operating profit projected to plummet. Their word might be different, but that's the feeling. Plummet by 58.8%, down to just JPY 500 billion.
Half a trillion yen. From over 1.2 trillion, that's a huge drop. And net profit.
Same story, basically. Projected net profit attributable to owners down a whopping 70.1% to JPY 250 billion. Very, very conservative forecast.
What on earth is causing such a massive expected decline? Is the core business falling apart?
Not exactly the core business itself, according to them. It's overwhelmingly driven by two massive external headwinds they're bracing for. First, unfavorable foreign exchange rates. They expect that alone to knock JPY 452 billion off their operating profit.
Oof. And the second? Let me guess, tariffs.
You got it. They're projecting a net negative impact from tariffs of JPY 450 billion, and that's after they try to mitigate some of it. They also kind of hinted during the call that this super low forecast might even bake in the possibility of some kind of one-time accounting loss, just to be extra cautious.
So Forex and tariffs are basically wiping out a huge chunk of expected profit. What about vehicle sales volumes in this forecast?
It's a mixed bag. They actually expect motorcycle sales to increase again to 21.3 million units, mostly thanks to Asia.
Okay, bikes still some.
But they see automobile unit sales decreasing to 3.62 million. Sorry, I think I said billion before. It's definitely million, mainly because of expected slowdowns in Asia again. And power products are also expected to dip down to 3.67 million units, mostly in North America.
Right, 3.62 million cars. Got it. So fewer cars expected to be sold. If you strip out those huge Forex and tariff impacts, what would the underlying profit picture look like, did they say?
Yes, they did give that perspective, which is helpful. Excluding those big external hits, they estimate operating profit would actually be pretty much flat compared to the year just ended around that JPY 1.4 trillion level.
Okay, that's crucial context. It means they don't see the fundamental operation collapsing. It's these outside pressures that are causing the dramatic forecast dip.
Precisely. It really highlights the scale of the tariff and currency challenges they're facing right now.
Are they expecting any positives in the current year to help offset these issues, even partially?
Yes, they are banking on some positives. They expect sales of both motorcycles and cars to increase in North America specifically, and they think they can continue to find some price and cost improvements.
But not enough to counter the big negatives.
Apparently not. They figure those gains will be largely eaten up by, again, rising R&D expenses and other costs. It's a tough balancing act. And that Forex forecast is based on 135 yen to the dollar, which they admitted is probably on the conservative side.
Okay, let's focus on those tariffs for a moment. That JPY 650 billion gross impact figure is staggering. Can you unpack that a bit more? What's involved?
Yeah, it's a huge number. It covers potential tariffs on both finished cars they import into the U.S. and also components they bring in. They stressed how complex it is to calculate because the rules are different for stuff coming from Canada, Mexico, or Japan directly.
Right.
And there's real uncertainty around components under the USMCA agreement, the new NAFTA. They don't have all the country of origin paperwork sorted, so they're playing it safe and assuming a hefty 25% tariff on a portion of those components in their forecast. It's clearly a major headache.
No kidding. So how are they planning to fight back, or at least cushion the blow in the short term?
They've got a few tactics. One is basically front-loading imports, building up inventory in the U.S. with cars shipped from Canada and Mexico before March, presumably ahead of any potential tariff deadlines or changes.
Makes sense. What else?
Big focus on internal cost cutting, naturally, and optimizing where they send their finished cars. We heard about them shifting production, moving Civic hybrid assembly from Japan to Indiana, and some CR-V production from Canada into the U.S. That's likely driven by tariff rules, trying to build where they sell.
Smart adjustments.
And they also mentioned working really closely with their dealers and suppliers, presumably to share some of the cost burden or find efficiencies together. They're being cautious about just hiking prices, though, watching what competitors do first.
So a multi-pronged defense strategy. What about longer term, if these tariffs stick around?
Midterm, they're looking at potentially boosting their production inside the U.S., things like maybe adding a third shift at existing plants or even running weekend shifts.
That's a big step.
It is, and they know it. They mentioned needing careful planning for the workforce implications and making sure the supply chain could handle it. They're also keeping an eye on U.S.-Japan trade talks, pushing for free trade, but admit their direct Japan to U.S. exports aren't huge anyway. It's really the USMCA rules impacting their integrated North American production that's key for them.
Understood. Now, let's swing back to that Canadian EV investment news. The $15 billion project put on hold. What was the main reason again?
The primary driver, they stated, was simply that the North American EV market isn't growing as fast as they and maybe others had expected just a year or so ago. So this huge project EV production, a battery plant, joint ventures, all planned to restart in 2028 is being paused for at least 2 years.
So it's just market reality biting. A pragmatic delay rather than a cancellation.
Seems that way, yes. A reaction to current demand trends. They did say they're talking constantly with the Canadian federal and Ontario governments about it.
And the governments are okay with a delay.
They mentioned they've received consent for the postponement, so it sounds like there's an understanding there, even if it's disappointing news for Canada.
Okay, shifting topics again. Amidst all these challenges, what about shareholders? How are they thinking about returns? I saw something about the dividend policy changing.
Yes, that's right. They're moving away from a simple payout ratio target. Instead, they're aiming for a dividend on equity, or DOE, target of 40%.
And what does that mean for the actual dividend payment?
For this coming year, fiscal 2026, it means a small increase. The annual dividend goes up by 2 yen per share, from 68 yen to 70 yen. So, signaling commitment despite the tough profit forecast.
A modest bump. Are they still buying back shares too?
They are. They gave an update on the big JPY 1.1 trillion buyback program they announced last December. As of the end of April, they'd already bought back nearly JPY 590 billion worth. So that's another way they're returning cash to shareholders.
Okay, let's talk management perspective. What was the overall vibe from the leadership on the earnings call? Confident? Concerned?
I'd say the tone was one of determined stability. They emphasized their diverse business, strong motorcycles, solid finance arm gives them resilience, and they stressed being flexible, ready to adjust strategy based on what the market's doing.
Like the Canadian EV delay.
Exactly. They leaned into the idea that securing stable revenue is key right now, pointing to rising hybrid sales, especially in North America. They mentioned current hybrids are 1.5 times more profitable than the previous ones. And again, relying on that motorcycle and financial services foundation.
So focusing on current strengths while navigating the EV transition. Did they give more detail on how their EV strategy might change given the slower market?
They acknowledge the slowdown requires a rethink, yes, but they kind of kick the can down the road on specifics, saying a fuller business update is coming on May 20th, so we need to wait for the details of their revised EV plan.
Ah, okay. So more news coming soon, hopefully.
Right. They did reiterate the long-term 2050 carbon neutrality goal is still there, but they admitted the path to the 2040 targets needs another look, given market realities and potential changes in regulations. It suggests maybe a more gradual ramp-up than they initially planned.
Understood. And lastly, there was a leadership shuffle mentioned briefly.
Yeah, relatively quick mention. Mr. Ayama resigned as executive vice president due to inappropriate conduct. They've appointed Mr. Kaihara to take over that role, and Mr. Inu is now heading up the automobile business division. Management assured everyone the new structure is solid.
Okay, so let's try and wrap this all up. It sounds like Honda had a, well, complicated year. Revenue up, thanks mainly to motorcycles and currency, but profit down due to R&D spending, EV incentives, and that big warranty accounting change.
Right. And the outlook for this current year is really dominated by fears over tariffs and unfavorable exchange rates, leading to that very cautious, much lower profit forecast.
But on the flip side, the motorcycle business is still a powerhouse, and they seem to be doubling down strategically on hybrids in North America, which are profitable for them right now.
Exactly. The Canadian EV pause looks like a pragmatic adjustment to market speed. And they're actively trying to manage the tariff situation through production shifts and cost control. Plus, the dividend increase and buybacks show they're still focused on shareholders.
So the big picture feels like a fundamentally solid company facing some serious external storms, especially around trade and the pace of electrification, and they're adjusting course accordingly.
That sums it up well, which leads to the big question for you, the listener. Considering Honda's strength in bikes and their current success with hybrids, how well do you think they're really set up to navigate these next few years? Can they handle the trade policy roller coaster and the tricky EV transition?
And maybe, what should we be looking for in that May 20th business update? Will it signal a major shift in their electrification timeline or strategy? Lots to think about there.
Definitely. If you want every single detail, of course, the full reports are available from Honda.
Indeed. Well, thanks for joining us for this deep dive into Honda's earnings.